stop what you are doing. I do not say that on this channel for dramatic effect. I say it because what HMRC published, announced, and set in motion across the last 6 weeks contains changes that are either already affecting your tax position right now or are building toward a decision point that closes before most people watching this have even heard it exists. My name is Frank. Welcome back to HMRC Update. And today I want to go through the HMRC updates from this summer that you genuinely cannot afford to ignore. Not as background information, not as something to look into eventually, but as things that require a specific action from you, in a specific order, before specific windows close. There is no filler in this video. Every piece I cover has a direct financial consequence, and at least 2 of them are time-sensitive in a way that makes August 2026 the month that matters. Not September, not January, this month. If you are not subscribed to HMRC Update, please do that now and hit the bell. The updates I am covering today came from HMRC's own publications, the August 2026 Tax News and the June 2026 HMRC Tax Update Package. None of it arrived in a letter addressed to you personally. Subscribe. Let us get into it. The first update that cannot be ignored arrived last week, and it has already passed its first deadline for 864,000 UK taxpayers who did not know it existed. New HMRC rules mean around 864,000 taxpayers in the UK faced an August deadline for the first time. Making Tax Digital is being phased in by HMRC, and a key change means that those who do their own tax returns now have to do quarterly submissions. Those with a turnover over £50,000 in the 2024 to 2025 tax year should be using Making Tax Digital as of the 6th of April 2026. This group was affected by the deadline of the 7th of August 2026. If you are self-employed or a landlord with gross income above £50,000 and you missed the 7th of August quarterly update, that is the situation you are
now in. HMRC confirmed there are no financial penalties for missing quarterly updates in the first year of mandation, 2026 to 2027, as a grace period for affected taxpayers adjusting to the system. But the grace period has a ceiling. Although HMRC will not issue penalties for missing a quarterly update during the first year, delaying it could create a bigger administrative and financial headache. The reason delaying creates a bigger problem is that 4 quarters of records become more difficult to reconcile as time passes, and the final declaration, due the 31st of January 2028, carries immediate financial penalties with no grace period. A taxpayer who leaves all 4 quarters unfiled and attempts to complete everything in January 2028 is managing a year's worth of unreconciled records under deadline pressure. The rule changes are being phased in year by year. Those who had a turnover of more than £30,000 in the 2025 to 2026 tax year will need to use Making Tax Digital from the 6th of April 2027. Those who are over £20,000 in the 2026 to 2027 tax year will need to use it from the 6th of April 2028. The action right now, if you are above £50,000 gross and have not yet filed your first quarterly update, is to get compatible software in place this week and submit the Quarter 1 update as soon as your records allow. The next quarterly deadline is the 7th of November 2026. If you are approaching the £30,000 threshold, April 2027 is 8 months away. Select your software now. The second update that cannot be ignored involves something that has never previously existed in UK tax law, and that changes the legal framework around tax mistakes in a direction that every UK taxpayer needs to understand before it becomes law. HMRC's latest tax update, published on the 23rd of June 2026, sets out a range of consultations and policy announcements that indicate where the tax system could be heading over the coming years. The proposals focus on making the tax system
simpler, more digital, and, in HMRC's words, fairer. One of those proposals is the draft legislation published on the 13th of July 2026, introducing a new legal duty to correct errors in tax documents, together with a power for HMRC to issue what it calls a customer correction notice. Under the proposal, a taxpayer who becomes aware of an inaccuracy that has led to a loss of tax must take reasonable steps to fix it, either by amending the return or by notifying HMRC. The obligation applies while the error can still be corrected within existing statutory time limits. It reaches individuals, businesses, and the advisors who file on their behalf. The consultation on this proposal closes on the 7th of September 2026. That is 3 weeks away. Here is why this matters to you right now, even though the legislation is not yet in force. The duty to correct is the direction of travel. HMRC is moving toward a legal framework where knowing about a tax error and doing nothing is treated as deliberate noncompliance rather than passive oversight. The difference in penalties between voluntary disclosure before HMRC fines you and being found by HMRC is already significant.
Penalties on voluntary disclosure sit between 0% and 30% of the tax owed, while penalties where HMRC identifies the error first sit between 30% and 70% of the tax owed, and in deliberate cases up to 100%. The new duty to correct, if legislated, removes the defense of inaction entirely. If you are aware of any error in your tax affairs, an income source not declared, a relief claimed incorrectly, a previous year's return that was not quite right, the correct window to act is now, under the current framework, while voluntary disclosure carries its lowest possible penalty treatment. Do not wait for the new duty to come into force. Drop a comment below if any of what I have just covered applies to your situation and you had not heard about the duty to correct consultation before this video. Back to the updates. The third update that cannot be ignored is the one most likely to affect your cash flow planning, and it is the consultation that closes in just over 3 weeks. Perhaps the most significant proposal is a consultation on timely payments for self-assessment taxpayers. The government is exploring ways to collect more tax during the year rather than relying on large payments due each January and July. For taxpayers who have both PAYE income and self-assessment income, the proposal could require more of their tax liability to be collected through PAYE from April 2029. HMRC is also considering wider reforms to the payments on account regime for other self-assessment taxpayers. These reforms would require taxpayers to pay all of their forecast tax liability during the tax year, with a balancing payment or repayment being due when their tax position is finalized on the 31st of January following the end of the tax year. For many sole traders and landlords, spreading payments throughout the year could help with budgeting and reduce the shock of large tax bills. However, it may also accelerate when tax is paid, affecting cash flow planning. This is the reform that changes when your tax leaves your bank account, not how much tax you pay, but the timing of payment relative to when you earn the income. Currently, a sole trader earning strong income in the 2026 to 2027 tax year does not pay the majority of that year's tax until January and July 2028. Under the timely payments proposal, a larger portion would be collected in real time, either through more frequent payments on account during the year or through PAYE adjustments for those with employment income alongside self-employment. The consultation on timely payments is open for responses until the 4th of September 2026. If you are self-employed or a landlord and your cash flow management depends on the current January and July payment structure, using the gap between earning and paying to invest, manage
Working capital, or simply smooth your personal budget, this change would materially alter that position. The consultation is the moment to make that view heard. After the consultation closes, the government's analysis of responses begins and the direction is set. Go to gov.uk and search for the Timely Payments Income Tax Self-Assessment Consultation to submit a response. The fourth update that cannot be ignored is the one that most people outside the tax profession have not heard about at all, and that changes the entire information landscape around tax compliance in the United Kingdom. The Strengthened Reward Scheme, launched at Budget 2025, offers individuals a potential reward of 15 to 30% of the tax collected, excluding penalties and interest, if their information leads HMRC to collect at least £1.5 million in tax. This is HMRC's whistleblower scheme, formally strengthened and financially incentivized for the first time. Before Budget 2025, people could report tax fraud or non-compliance to HMRC, but there was no financial reward for doing so. The Strengthened Reward Scheme changes that. An individual who reports tax non-compliance that leads to HMRC collecting at least £1.5 million in tax is now entitled to a reward of between 15 and 30% of the tax collected. On a collection of £1.5 million, that reward is between £225,000 and £450,000. The practical consequence for UK taxpayers is not that they need to become informants. It is that the environment in which tax non-compliance can remain hidden has changed fundamentally. Business partners, former employees, disgruntled directors, contractors, and ex-spouses all now have a significant financial incentive to report suspected tax non-compliance to HMRC, if the figures are large enough to trigger the scheme. The volume of disclosures reaching HMRC has already increased since the scheme launched. The quality of those disclosures, the specificity of the information, the corroborating evidence attached, is
also increasing as people learn the scheme exists and how to use it. This does not create a problem for anyone whose tax affairs are in order. But for anyone who has relied on informal arrangements, undeclared income, or compliance positions that depend on nobody with direct knowledge choosing to report them, the risk calculation has permanently changed. The correct response is not anxiety. It is a review of your current compliance position and voluntary disclosure where anything is not as it should be, while the penalty treatment for self-initiated disclosure is still substantially lower than for disclosures HMRC receives from a third party. The fifth update that cannot be ignored involves a change that sounds administrative but has a direct financial consequence for anyone who relies on a tax advisor to manage their HMRC affairs. As part of the government's initiative to raise standards in the tax advice market, tax advisors who interact with HMRC on behalf of clients will be legally required to register starting in May. From May 2026, any individual or firm acting as a tax advisor and interacting with HMRC on behalf of clients must be registered with a recognized professional body or with HMRC directly. Unregistered advisors cannot submit returns, make representations, or correspond with HMRC on your behalf through the Agent Services account. Here is where this becomes a financial issue rather than a professional one. If you currently use a tax advisor, an accountant, a tax agent, or a self-described tax specialist, and that advisor is not registered under the new requirement, any return they file on your behalf from May 2026 onwards is filed without proper authorization. HMRC may reject the submission, treat it as unfiled, or remove the agent's authority to act. The resulting compliance problem, a missed deadline, an unfiled return, a gap in your tax record, lands on you, not on the advisor. Your name is on the tax return. Your national insurance
number generates the liability. Your penalties accrue. The action this update requires is to confirm with your current tax advisor that they are registered under the new regime. Ask them directly, which professional body are you registered with, or have you registered directly with HMRC as a tax agent? A registered advisor will be able to answer that question immediately and specifically. If they cannot, or if they deflect the question, that is a signal that requires investigation before the next filing deadline. HMRC is improving its variable payment plan for those who pay via direct debit. This is designed to be more flexible, but it is important to check that your mandates are still active, especially if you have recently changed banks or business structures, such as moving from a sole trader to a limited company. If you pay HMRC via direct debit and you have changed your bank account, changed your business structure, or had any change to the bank details associated with your HMRC payment arrangement since you last reviewed it, check the mandate is still active through your HMRC business tax account or personal tax account. A direct debit that has lapsed without you noticing means payments are not reaching HMRC on time, even though you believe they are. Interest at 7.75% starts accruing from the day after the deadline on any payment that does not land in HMRC's account on time, regardless of whether you intended to pay. HMRC has changed how unincorporated businesses are taxed to align with the tax year. The basis period reform, which concluded with the transition year in 2023 to 2024, now means all self-employed businesses are taxed on profits arising in the tax year ending the 5th of April, not on their accounting year ending at some other date. For businesses that previously had a year-end other than the 5th of April, this change may still be creating timing differences in their tax calculations that are not yet fully resolved in their records. If your
self-employed business has an accounting year-end that does not coincide with the 5th of April, say the 31st of December or the 30th of September, review your current year tax calculation to confirm it is based on the tax year profits correctly apportioned under the new basis period rules, rather than the old preceding year basis. Any residual transition year overlap profits that were spread forward should also appear in the current year figures. So here is the complete picture of what cannot be ignored and what the action looks like for each one. Making tax digital quarterly submissions. 864,000 taxpayers in scope from April 2026, with the first deadline of the 7th of August just passed. Submit your Quarter 1 update as soon as records allow. The next deadline is the 7th of November 2026. The duty to correct consultation closes the 7th of September 2026. If you are aware of any error in your tax affairs, act now under the current voluntary disclosure framework before the new legal duty takes effect. The timely payments consultation closes the 4th of September 2026. If you are self-employed or a landlord and your cash flow management depends on the current payment structure, respond before that date at gov.uk. The Strengthened Reward Scheme is live. If your compliance position relies on informal arrangements or undeclared income, the financial incentive for those with direct knowledge to report to HMRC has permanently changed. Voluntary disclosure now is substantially less expensive than being reported. Confirm your tax advisor is registered under the new mandatory registration regime from May 2026. An unregistered advisor cannot legally interact with HMRC on your behalf, and any submissions they file may be treated as invalid. Check your HMRC direct debit mandate is still active if you have changed bank accounts or business structures since you last set it up.
HMRC published the 23rd of June tax update package containing all of this simultaneously, a raft
of consultations and policy announcements aimed at making the tax system simpler, more digital, and in HMRC's words, fairer. What that means in practice is more data, more automation, more reporting obligations, and a legal framework that increasingly treats inaction as non-compliance rather than oversight. The people who cannot afford to ignore this update are not the people who are doing something wrong. They are the people who have not yet checked whether the new rules reach them, who assumed that what applied last year still applies this year, who are using a software tool or an advisor without verifying it is still compliant with the current requirements, or who made a plan around payment timing that the timely payments consultation could fundamentally change from April 2029. Share this with someone who is self-employed, uses a tax advisor, or has been putting off reviewing their HMRC position since April. The summer of 2026 is not a quiet period for UK tax. It is one of the most significant periods of change and consultation in years. The people who act on that information now are the ones who stay ahead of it. Subscribe to HMRC Update if you are not already here.